AI could be a big boost for metals with energy needs set to soar for all those data centers. But is the demand for real, or are we just seeing a lot of hype? James Fishback is co-founder and chief investment officer at Azoria. James, welcome to Kitco.
It's my pleasure, Michael. Great to be here.
James, help me out. I'm going to be writing up this story about this interview, and I'm going to be using some AI tools that's going to help with my spelling. It's going to help with other edits. I get the applicability, but the tools are adequate. Just tell me, why are companies making these big bets on the next generation of AI? I see Alphabet, and then that's just one example, is set to spend about $50 billion on data centers alone this year. The other tech giants are making similar investments. What's the business case that I'm missing, James?
The business case is the most transformative technology since the internet. And there's ways that you do that by creating new revenue streams for companies. It gives companies like Microsoft and Google pricing power over existing services. But it's incredible. I mean, let's just take a step back for a moment, because there's so much innovation happening so quickly that we lose track of just how impressive this technology not will be, Michael, but is today. I can take a napkin, you and I can have lunch, and I can take a napkin and sketch out a website. And using technology that's available today, ChatGPT's 4 Omni model, take a picture of that napkin sketch and turn that into programming language for a live website within a matter of minutes. And so that's just one way to think about how transformative this technology is. And so the question now becomes for investors, how can we monetize this? Not just through the companies themselves who are going to be creating this technology and deploying it, but the actual physical commodities, whether it's in the copper space, whether it's actually energy needs that are going to be required to really power the next generation of technological innovation.
The word that gets thrown around, though, James, is hype. Is there concern that this could all vaporize? Are the checks, have the checks been written for these data centers, for the people that are interested on the upstream? For instance, what if the next AI model from Anthropic or OpenAI just doesn't wow us?
That's a great question. I actually think there is a concern about hype, to tell you the truth. And it's the fact that this technology is underhyped, not overhyped. It's very easy to get excited and say something is overhyped because the stock price has gone up, in the case of NVIDIA, 150% year to date. But we're already seeing use cases right here, right now. The number of software development positions was a little over 200,000 2 years ago. Now it's below 50,000. A big part of that is AI-driven programming that can replace a lot of low-level and mid-level data scientists and data programmers. I got to tell you the truth. I'm building this new company called Azoria, this investment firm, and we opted out of hiring a third investment analyst because we're using ChatGPT-4 and other custom tools we've built around their API to effectively replace what an analyst would have done. And so, I tell folks who are looking for work right now, you've got to be in the top 10th percentile, at 90th percentile and above, or in these fields, whether it's in being a paralegal, doing data research, or you're going to be replaced by this technology sooner rather than later. McKinsey estimates that up to 30% of working hours are going to be replaced by generative AI technology. And so I am astounded, but I got to tell you, if there is an issue with hype, Michael, it's that generative AI is underhyped relative to the ultimate transformative impact this technology will have.
Let's step back and talk about macro, James. We're recording this on July 11th. Yesterday, Powell appeared before the Senate Banking Committee. What are you watching?
What I'm watching more than anything is how the Fed is thinking about undoing its latest mistake. Powell has made 4 distinct mistakes, the first of which was transitory. You'll remember that, Michael. That led to a big move in gold and silver, and of course in something called inflation, when they totally misjudged what the drivers of inflation were. Let's just go back for a moment to the spring of 2021. Inflation hit 5% for the first time in June of 2021. Did the Fed raise rates from 0 in June? No. What about July? No. September? No. November? No. December? No. It took them until the March meeting of 2022, a full 9 months later, to get off of zero, the zero lower bound, and pull this liquidity away from the system. And so Powell has really been thinking about that issue, that mistake from the beginning. The latest mistake he's made was when they had that mission accomplished December Fed meeting, and they started talking about, well, we think we're going to need to cut rates 3 times. And the market, in its infinite wisdom, heard something like 6 or 7 and proceeded to price 6 or 7 rate cuts at its peak in January of this year. And of course, we all know what happened next. The inflation data was not as rosy, continued to surprise to the upside. The inflationary forces, the good news that we saw in the second half of last year, we took all of that back. And so right here, right now, Powell is on the precipice potentially of another mistake. Does he want to keep rates too high in his mind, thinking that it would jeopardize the job market? Although for the most part, the consumer is pretty strong. There's weakness in lower income segments of the American consumer. But for the most part, the American consumer is strong. Or does he want to pull back rates prematurely and then risk reigniting that crippling inflation that we saw in 21 and 22? And so that's where we are. I got to tell you the truth. What our working assumption has been that we saw 3 months of bad data at the beginning of this year, and you're going to need 5 to 6 months of good data, not perfect data, but good data to give the Fed the confidence. That's the word we hear Chair Powell talk about all the time, confidence. To give Chair Powell the confidence that inflation actually is headed back to its 2% target. And so I think September is too early to move. I do think we're going to get one rate cut likely after the election for the same reason that they don't want to pull a James Comey and feel like they're putting their thumb on the scale. Yes, if the labor market, Michael, does fall out of bed in August or September, I don't think they'll have a choice but to cut. But notwithstanding a rapid deterioration in the labor market, the Fed is on hold until after what I would argue is the most important presidential election in this country's history.
You mentioned the James Comey effect. I just wonder if the Fed has, how constrained it is in terms of being able to move when we're in the midst of a U.S. election and a very contentious U.S. election.
Yeah, it's a good point. I mean, certainly they weren't constrained in 2008, but then again, we knew what happened in September of 2008 with the collapse of Lehman Brothers, of course. And so that was a very different situation today. There's no question that if they were to cut at the September meeting with the rough data landscape that we have today, it would be a close call. And I think in a close call, in a tie like that, the Fed errs on the side of looking less political. I don't believe they're going to be political at this point. I had my doubts earlier in the year when they started going from we're not cutting anytime soon to we're going to cut 3 times. I think that ship has sailed for them, and I applaud Jerome Powell for walking back the rate cuts that were priced earlier this year in light of the bad inflation news. But there's no question about it. They can say all they want about how they're not political, but they're a political organization, Michael. 97% of donations from the Federal Reserve System go to the Democratic Party. It was the New York Fed president, Bill Dudley, who wrote in Bloomberg Opinion in 2019 that the Fed should not cut rates in the wake of trade tensions because, quote, it would lead to another Trump presidency. And so this organization has an awful track record when it comes to separating politics from policy. I hope that they will, and it looks like they will for their own self-interest, avoid being political. There's no need to. As Chair Powell said at the last press conference, the difference between cutting in September or in December isn't going to make a difference in the long term. But I think that he fears the perceived political credibility of the organization, and that will weigh on his decision and likely cut against them cutting in September.
James, what's been remarkable over these last handful of years is that, I knew that the Fed is an important institution for markets, but I think it's been reaffirmed or even been made more pressing just how important an impact that the Fed is going to make. I just wonder, though, how the Fed kind of steps away from markets. I just kind of wonder how it kind of steps away from the economy.
That's a great question. There is no doubt that there is this codependency with the markets and the Fed. The reason being is just look at what happens when Jerome Powell speaks in front of Congress or gives a press conference. You could drop a pin on a Goldman Sachs or Morgan Stanley trading floor because that's how quiet it is. Everyone is attentively focused on the Fed, whether it's on the next round of QE, as we saw in the post-08 period, whether it was on rate cuts going into the 2020 pandemic, or of course the rate hiking cycle. I do think there is good news, and that is the American economy is resilient and is becoming less and less dependent, even if investor psychology is still short-term focused on the Fed, that there is less of that relationship when it comes to markets, capitalism, and actual growth. Let's just be honest for a moment. At the beginning of this year, the market was pricing 7 rate cuts. And a lot of people were saying things like, if the Fed doesn't deliver these 7 rate cuts, the stock market's going to fall out of bed. Well, the market is not going to be delivering these rate cuts. And look at what the stock market has done. It's up 16% year to date. The NASDAQ, of course, even higher. And so I think that right around zero rates, we tend to see really excessive speculative bubbles, whether it be NFTs or certain stocks like Zoom around the pandemic trade. But, I would argue that the Fed has less of an impact on the real economy today than it would 25 years ago. If you would have told your listeners 2 years ago that the Fed would have taken rates from 0 to 5.25 at the fastest rate since a guy named Paul Volcker, how many of them would have thought that unemployment would not have gone up, but would have been lower? How many have thought we would have had the GDP growth that we did in the fourth quarter and the first quarter of this year? How many would have thought the market would be up over 30% in that period? And so I would just say the American economy, the American entrepreneurial spirit is alive and well. And as much as short-term markets want to focus on, did the Fed hint toward a cut? Did they move a comma? Did they change modestly to moderately in the statement? What we need to focus on is the actual fundamentals. And beyond a multi-week time frame, that's what reigns true for investors today.
What are you watching outside of the US, James?
I think the biggest thing outside of the US right now is geopolitical tensions. We have to just be honest about the risks that are out there. We very early on had the nuclear word come up in the Ukraine-Russia conflict. I think that probability is awfully low. It's certainly not zero, but it's awfully low today. We had this conflict, this awful attack on the great state of Israel on October 7th, and all of the geopolitical instability that has come out of that. And of course, what's going on between Taiwan and China. And so I think the biggest thing now is when we think about this election, most elections don't matter for markets. I think we just have to be completely honest about that. Whether markets were going to pick a guy named Mitt Romney or Barack Obama in 2012 didn't matter. But when you're looking at the last 4 years of Joe Biden and what could be 4 years under Donald Trump, there's a lot to consider there. And the biggest one that no one's really talking about is geopolitical chaos. Objectively, whether a listener might be a fan of Joe Biden or not, these have been 3.5 years of utter geopolitical chaos. Whether it was the disastrous withdrawal from Afghanistan, Russia's invasion of Ukraine, Iran and Hamas's attack on Israel, it has been conflict and chaos around the world. And you may not have liked Trump's tweets, you may not have liked the way he said certain things, but we got effectively geopolitical stability through a little something called peace through strength. And so I think if Trump comes in, what I'm looking at is a lot of these geopolitical hotspots, whether it's Russia, Ukraine, Israel, Hamas, China, Taiwan, I would expect those to come to some semblance, not of peace, but of détente, of stability for the foreseeable future. And that has large implications for commodity markets, for the pricing of risk globally, for volatility. And that's something that I'm looking at as well. And that's part of this framework for thinking about the 24 election.
Question about gold, James. Now, Azoria is a multi-asset investment firm. You did mention geopolitical concerns. We have a lot of guests here on Kitco that are very close to gold. They follow the metals closely. I'm asking from your perspective, though, that how would you say is looking at a number of broad investments? How do you view gold?
Gold is one of the most important financial assets in the world. I was 9 or 10 years old, and my grandfather, Cliff, a World War II veteran, gave me the gold talk. And he gave me the gold talk because, Michael, he had gone through the Great Depression. He had seen the bread lines. He had seen the devastation, the suffering, the agony. Gold needs to be a part of every investor's portfolios. I don't necessarily think it needs to be a speculative asset on one particular move or the other, but I think you have to have a small but still somewhat significant allocation to gold when you look at what's happening in the Middle East, when you look at what's happening between Russia and Ukraine, and there's that risk, not 0%, not 10%, but definitely not comfortable of real escalation in these conflicts. And so gold is that asset. It may not trade the way you want it to after a Fed meeting or after a CPI report, but what we've seen, whether it's the central banks of the world, specifically the emerging markets, moving away from the dollar, gold is going to be a beneficiary of that as the world effectively de-dollarizes and becomes less dependent on the US financial system, which, objectively speaking, was weaponized, rightly or wrongly, was weaponized against the Russian government in the wake of their invasion of Ukraine. And so gold is the asset to own. I'm not a fan of using it as a speculative tool. I'm a fan of owning a portion of it, a small portion of the portfolio, and letting it sit there and using that as really a way to sleep at night, because what's going on in the world, the chaos and instability, it does underwrite the gold price long term.
Lastly, James, what are your best ideas? What sectors work in this environment?
This environment, I think you can think about this environment not as the next 3 to 6 months as most market analysts do, but the next 10 years. And that's what I'm doing at Azoria, is building an ETF manager for everyday Americans, whether you're a firefighter in Coeur d'Alene or a nurse in Cincinnati. We want to help you compound your wealth, not to replace a stock portfolio or a gold portfolio, but to be a part of your existing portfolio. The number one trade is the technological innovation that we're going to see over the next 8 to 10 years. It is going to make the late 90s and early 2000s look like elementary school math. What autonomous driving is going to do, what we're going to see out of products like Optimus, which is this humanoid robot that Tesla is fast developing, full self-driving, generative artificial intelligence. This technology is a game changer. And if you can write on a napkin today a website program, take a picture of it, and in just a minute, create that into a live working tool online, that is just the beginning of something special. And so if there's an issue with hype, Michael, I think these technologies are underhyped. Now it's about knowing what to own. And that's what we're spending a lot of our time at Azoria doing, is popping open the hood, better understanding, yes, companies like NVIDIA who have had a great run, but other companies that may be undervalued relative to what these technologies will end up delivering for the next decade.
James, thanks for your time.
My pleasure. Thank you.
My name is Michael McRae. You're watching Kitco Mining.